Well, welcome back to another episode of the Financially Free Journey podcast. And I'm your host, Courtney Dyer. And as you guys know, this podcast aims to dispel the seemingly complex topic of personal finances, money management, debt, savings, investing, real estate, and retirement. And today I have a very special guest, Paul Moore, and we are going to be talking about all things real estate investing. Paul has actually successfully completed over 85 real estate investments and exits, including a large multifamily development. He's done it all, residential, commercial. We are going to talk about it today, and we're going to answer all your questions. So, Paul, welcome to the show.
Hey, it's great to be here, Courtney. Thanks.
I'm really pumped for this because one of the top topics that I get messages and emails about is real estate investing, especially in this market. It is so hot right now.
I know it is really crazy, and it's a really hard time to invest. And I wrote a book called The Perfect Investment about multifamily investing in 2016. And then about a year later, I started warning people not to invest in multifamily unless they're very, very careful. But things are changing right now with all the inflation and the 5,000-year low interest rate we're experiencing. And there's some reasons to try to dig in and find deals anyway. But yeah, it is a crazy time for sure.
Well, you touched on inflation. Let's talk about inflation in real estate investing, shall we? And how they're connected.
Yeah. So, a lot of us lived through, you probably didn't, but a lot of us lived through, watching our grandparents and neighbors and others suffer during, the high interest rates, high inflation era known as stagflation, et cetera, from the 70s and into the early 80s. And we watch people, whose pension check would pay 2 months of their mortgage or their rent. Now it would pay 2 weeks. And we watch people's savings be completely, just completely decimated. And so people think inflation's a really, really bad word. And it is. But if you know how to use it to your advantage, it doesn't have to be. And there are people, we talk about Dave Ramsey, and Dave Ramsey talks about why you should not get credit cards and consumer debt. We agree. That's a bad kind of debt. But there also is a good kind of leverage that works really, really well in times of inflation. I mean, think about it. Imagine a graph showing your expenses on one line, your biggest expense being your mortgage payment, typically. I'm talking about residential and commercial, but then the revenues on a separate line going up over time. Now imagine this, Courtney, if you can lock in an interest rate, your biggest expense typically at a very low, historically low rate, but then you have revenues going up year after year for 10, 12, maybe 30 years, that growing gap is your growing profitability. And so if you can lock in an interest rate and do a fair, safe amount of leverage, and then watch the revenues climb over a year just by inflation, that's without doing any heavy lifting. You can do that too. We recommend it. But it can be quite a profitable hedge against inflation.
And that's something that I think a lot of people are not necessarily discussing right now, is that inflation can be a hedge. You can hedge against it with real estate. And so a lot of people are just saying, oh, no, inflation is terrible. But if you're being strategic, you can really hedge against it with proper real estate investing and, locking in such a low interest rate. I mean, right now it's like banks are giving away money compared to what interest rates used to be on even commercial loans, which are historically higher interest rates than residential.
Right. It's amazing. I mean, who would have thought we'd be able to get a loan on a $5 or $10 million mobile home park at 3.0% interest, and then lock it in for 12 years. A lot of revenue can be generated in 12 years, especially on a value add property, which means a property that's maybe not well run when you buy it, and you can professionally manage it and up the standards, and just really everybody wins in that, like the investors win, the bank wins, the operator wins, the tenants win. We've got lots of stories about tenants bringing cakes to the office, thanking them for taking over. And yeah, they up the rent $25 or $30, but look at all they've done for the community. There's all kinds of great things like that where everybody wins in these type of situations.
You just mentioned investing in a mobile home park, and obviously we've talked about residential and commercial, which I think are the two main categories that people think about when investing in real estate. But I read that you've invested in flips and subdivisions, multifamily, self-storage, mobile homes, and hotels, right? So in your opinion, what's the best option for a beginner? Because that's a lot of our listeners are like, hey, I want to get into real estate, but I'm kind of nervous. I mean, what's your take on that?
Yeah, I just wrote a 4,000 word, exhausting article about this topic. And, it's so residential real estate. We think I was on HGTV once. And, you think about like Chip and Joanna Gaines. Oh, I could do that. Look, watch this, honey. We could, do this. Well, it's really, really hard right now because so many people are competing. So many people watch, so many people watch HGTV and they see these shows. And yes, they might be able to do it, but there's tremendous competition. I just got off the phone with a $350 million hedge fund who is investing in thousands of single family homes. They're competing with you and me now if we're trying to buy those. So it's really hard to get in. The margins are really thin and the possibility of error is pretty high. But here's what I don't love about single family homes on top of that, and that is that the values are based on comps or comparable properties. Let's say you bought a $300,000 home for $250 because it had hoarders in it and it was outdated, and you might be able to get the value up by improving it. Well, you go in, and actually I did this twice, so I know. You go in and spend hundreds of thousands. You build out the attic and you build out the basement. You put on an addition. You put in gold-plated fixtures. I'm kidding, but you get the idea.
Yeah.
And let's say you put $300,000 into that. Well, now you've got $600,000 in there, and you all of a sudden realize, wait a minute, this is a $400,000 neighborhood. You're going to have a real hard time making a profit on that because the neighborhood, as we all kind of know, is going to keep the price down. Commercial real estate's entirely different, Courtney. It's based on something that your mama told you to do well, and that is math. It's based simply on math. And it's a beautiful formula. It's sort of similar to the price to earnings ratio in the stock market. It's this: the value or the increase in value of commercial real estate is the net operating income, which is just the income from the property, divided by the rate of return, also known as the cap rate. And if you can increase that numerator, the income, and if you can keep the denominator constant or even possibly shrink it a little bit, and I can talk about ways to do that, you can significantly increase the value of the property. And it's not based on other properties around. It's based on just math, which is somewhat within your control, not completely, of course. And if you can do that using safe leverage, it is amazing the gains that can be made. And Courtney, I'll just say I was curious about commercial real estate for years while I was doing single family and residential and single homes, but I didn't know how to get in. And I found out that the wealthiest people in the world, most of the Forbes 400 in America, for example, almost all invest in commercial real estate. This math equation is one of the reasons why. Another reason is the incredible tax savings that are available to commercial real estate investors.
So talk a little bit about the tax savings. What does that entail exactly, just for the average person listening right now? How would that impact them?
Well, I sat with a commercial real estate investor who had been in the business for like 2 or 3 decades, and he was showing me how he could take 20. I know most people don't invest 20 million, but the point's the same. He was showing me how to take $20 million and over 10 years, reinvest all the profits. And then in year 11 through 20, throw off profits. And that 20 million would build a portfolio valued at a total, counting leverage, of about 210 million over 20 years. It would also throw off 131 million in cash flow in the second 10 years. But here's the part that really amazed me. He said you could do all this without paying a dime in tax, other than property tax, of course. And so I couldn't believe it, but he showed me, and it was true. There are so many tax saving opportunities for real estate investors. It's second only to oil and gas investors, and it's a lot more stable, a lot more predictable than most oil and gas deals. And so, I mean, if you want, we could dive into these. Yeah.
A lot less risky. Well, and just simple tax savings like accelerated depreciation on buying properties, for example, and a lot of times, depending on how you've structured buying into the commercial real estate, that can be a pass through to yourself personally to really be an offset to your personal income if you have earned income, W-2 wages. So there are so many great ways. And again, guys, you got to listen, you got to go talk to a CPA, but we're just generally speaking about some tax saving opportunities in addition to appreciation on the property, cash flow on the property, locking it in at a very low interest rate, and giving yourself a way to be able to write off, with a pass-through loss to your personal income. It really is a great thing to research.
It really is amazing. And you're right about all that, Courtney. One thing I was telling somebody today is we've got an investor who's getting up there in years, and he has been doing 1031 exchanges, which means he has been foregoing the capital gains and other taxes for decades. And if he passes away without selling that last property in this chain, his kids won't have any tax from all those years that decades he went without paying tax on it. They'll never be taxed because of a little thing called reset basis when someone passes away. There are just one thing after another. And the 2017 tax law changes made it even better than ever.
So when you're thinking about all of your experience that you've had with investing in real estate, I mean, what would you say is the most common pitfall that people fall into when they're trying to get into real estate for the first time? And how can our listeners avoid that?
That's a great question. And do I have your permission to potentially offend a good portion of your audience here, Courtney?
You know what? We're not here to be PC'd. Tell the truth, Paul.
Okay, I'm going to tell the truth. I'll tell you how I have made so many mistakes. I was finalist for Entrepreneur of the Year in Michigan a couple of decades ago. And I made this massive mistake. I kept repeating it appeared, of chasing shiny objects. And I would be doing really well on this one track. And then I'd see something else, like the guy who this morning at breakfast told me he was making 500% profits a day in this cryptocurrency speculation thing. I used to get so excited about stuff like that, and I would chase these shiny objects, but I was never full time at those. I was never fully devoted, fully focused. And real estate's the same way. And this is where I might offend some people. It's really, really hard to make a lot of money and create a lot of wealth in real estate part-time. If you're full-time, doing your IT job or doctor, dentist, lawyer, or even retired and enjoying it, doing real estate on the side can be a disaster. Not only do you not have, the team of people typically and the buying power and the time, dealing with toilets, tenants, and trash on the side is usually a real hassle. I was talking to a medical professional I met at a wedding recently, and he was saying he had 42 units. And I stayed in touch with him. He said he rented one of those units and on Monday, and then on Wednesday, the tenant set his apartment on fire. And he's going to have to deal with that for months and months and maybe even longer. Maybe it'll end up in a lawsuit. Maybe another tenant who knows what'll happen. He's making so much money in his medical profession. I had to wonder, he's charging like $600 a month for these units, these apartment units, eking out a profit. Is it really worth it? And so my bottom line on this is it's usually not worth it to do it part-time. There are so many reasons, so many horror stories I could tell, but it is great if you want to get into real estate, if you can find somebody to invest with. For example, a friend of mine in Colorado, he invests his IRA funds with a local house flipper, and she pays him 12%. And he's glad to get the 12%. She's glad to get the money, and he doesn't have to do all the heavy lifting. And so the key to this, or you can invest in a REIT, or you can invest in a commercial real estate syndication or fund. There's so many ways to do it without doing all the heavy lifting, and leaving it to professionals is powerful. I mean, for example, imagine in the stock world, if you invested yourself, your return, your profit, I think over 55 years would be, if you just invest in the S&P 500, I think it would be 23,000%, which is awesome. But if you invested with a pro, specifically, I'm talking about Warren Buffett here, I think that's like 1,000 times higher return, if I'm not mistaken.
Wow.
It's incredible. And so investing with a pro is easier. It gives you your life back. It gives you a chance to be happy, not be spending your weekends, evenings, vacations, and lunch hours chasing deals. And it allows you to usually make a higher profit and often still get the same tax savings.
Well, and that's good because my follow-up was going to be, well, how do people transition from, hey, I'm a full-time W-2 employee of a company and I want to transition, but I can't just quit today. And it sounds like a great opportunity to get into real estate, if you're not doing it full time, is to invest with a pro, because again, there's so much risk involved that's behind the scene. Like the example that you gave of a tenant lighting a unit on fire, like that's a risk when you have an asset and you're renting it out to other people and property managers. And just, like right now with the memorandum that was actually just repealed, but a lot of times people weren't able to collect rent for, what was that, over a year now. So there's a lot of things, if you're not a professional doing it full time, that you have to account for. So I think that's a good piece of advice for the listeners to bite on.
Yeah, it's great. Well, yeah, you summarized that really well. It's so true. I mean, I wrote an article for Physician on Fire called How to Ruin Your Retirement, Invest in Real Estate.
This is how to not enjoy your time after working really hard. Is to become a landlord. Okay, so you've built a massive real estate portfolio and obviously been highly successful. What would you say are your greatest insights in things that you've learned that you could share with people looking to get into real estate?
Yeah, let's go over a couple. So one would be for all of life, and that would be the consideration of investing versus speculating. When I sold my company to a public firm in 97, I thought, I'm a full-time investor now, but I actually was a full-time speculator. And I didn't know the difference. Investing is when your principal is generally safe and you've got a chance to make a return. But speculating is when your principal is not at all safe and you have a chance to make a return. And I speculated a lot and I made some money and I lost a lot of money. In fact, I have a podcast called How to Lose Money. And speculating is one big way to do that, Courtney. And so I recommend a life of boredom when it comes to investing. I was an entrepreneur. I was a 30-something high-energy entrepreneur in the 90s, and I thought I should invest the same way, to get excited, to have fun, to enjoy my investments. But Paul Samuelson, who's the first economist to win the Nobel Peace Prize from the U.S., said investing should be boring. If you want excitement, take $800 and go. Let me say that over. Paul Samuelson, the first economist from the U.S. to win the Nobel Peace Prize, said investing should be boring. He said it should be like watching paint dry or watching grass grow. He said, if you want excitement, take $800 and go to Las Vegas.
I love that. Go take it to the craps table, because that's where you're going to get your adrenaline fix.
Right.
And I think a lot of people, I don't think, I know, and I know you do this, you have this experience as well, but a lot of people right now are chasing the high of the AMC and the GameStop and the Bitcoin, where they're getting, a 3,000% return on money. And it's really this instant gratification, like, but I should be able to turn this into 10 times my investment. That's not a long-term, strategy when it comes to investing and creating passive cash flow for yourself. It's got to be boring. Like you said, paint drying on the wall. That's what your investment strategy should be, because consistency is key.
It's really true. And the guy I told you about who was like 5Xing his money in a day on this crypto speculation fund, I think he's got like $100 million, and he's probably only speculating with, 10 or 20,000. I don't know exactly how much, but not much. The point is your process, your strategy overall should be about investing. Get that all buttoned down first. Then if you want to speculate a little on the side, have fun.
Do your thing. It's the same thing as hitting Vegas. It really is. Just
Yeah.
It seems more sophisticated.
Mm-hmm.
Oh, I love that. So investing versus speculating, what a great insight and takeaway. I mean, again, a lot of people get those misconstrued or get them confused for each other. Like I am investing when really they're not. As you said, you had that experience yourself.
Yeah, it's so true. And another one is chasing shiny objects. I mean, Gary Keller in his great book, The One Thing, that you've talked about on the podcast before, I believe.
Yeah.
He quotes that proverb, he who chases two rabbits catches neither. And if you want to go out and spread your time, your effort, your mental space out doing two or three things, chances are they could all fail. A friend of mine who ran for governor of Colorado was rubbing shoulders with billionaires, and he came back to me and he said, you know what? The difference between those billionaires and most of us is that they got on a track at a very young age. They got hyper focused on that one thing. They kept doing it even when it got really boring over decades, and they became uber successful rather than chasing all these shiny objects. And so that's another lesson I learned is stay focused. And I just had a chance to make a 60% return in a real estate thing. Wow. And it was really, really doable, 60% cash on cash by investing in Gatlinburg cabins. And my friend showed me it was definitely doable. But after about a month of thinking about it, I thought, you know what? I could do that, and I would love to go to my cabin in Gatlinburg, but it would be another distraction. I could make more money just staying focused on what I'm doing. And even if I didn't make more money, I know that I'd have a happier life when I didn't get that call in the middle of a Saturday night about the toilet that overflowed or whatever.
You weren't looking forward to that, Paul? That's not what you were seeking for your happiness?
Been there, done that.
I love it. I love it. Those are some really good insights. I wanted to, you mentioned this earlier. You have a podcast and it's called How to Lose Money. I need to know, why did you name your podcast that?
Yeah. So for years I would go to conferences and I would, hear these great speakers talking about their great success, but I'd notice on the breaks or in breakout sessions, the other men or women around the table would be kind of slump-shouldered. And it would be like, oh, I'll never have those breaks. I'll never have those opportunities. Boy, was that lady connected. Boy, did he have a great education. I'll just never make it. And I realized, I wish those people on stage would talk about their failures and pain. I went to this one conference 7 years in a row, and finally somebody got up and said, can you just tell us about some of your failures? And the whole panel was like deer in the headlights. They wouldn't talk about their failures. And I said, if I ever get on that stage or a stage, I want to talk about failures. I think it's more encouraging. And so we started the podcast with the goal of interviewing the most successful people you could find in investing and in business and entrepreneurship. And we interviewed 238 successful people about their pain and losses and failures and mistakes on the way to the top. And I think our listeners were deeply encouraged because they realized, oh, this famous person like Gino Wickman of Traction or Mike Michalowicz from Profit First, whatever, they had these same problems and pain and failures that I did, sometimes even worse, and they're successful now. I think I can do it too. Well,
it's important to, in this culture that we live in where everybody's putting out their highlight reel, right? Where we're seeing the best of everybody. Same when it comes to being an entrepreneur and an investor. There are the highs that we love to highlight and tell everybody about, but there's also the lows, and understanding that is a part of the journey. There is going to be those situations where you're like, I just made a really stupid decision, or I can't believe I invested in this. And for people that are highly successful to be willing to share and say, hey, yeah, I haven't always made the best decisions or the best investments, or I've never not made a bad deal. That is so important for everybody listening, because it's like, that's a part of the journey.
Mm-hmm. It is so true. And I can't think of anybody who's really successful that didn't start out, or at least didn't have major failures along the way.
Yeah. No, it's important to recognize and understand everybody does it. No one's perfect, not even Warren Buffett. So, what would you say, Paul, is the best piece of financial advice that you have ever received and why?
You know, just circling back to that issue of investing versus speculating, I've got to say that was the best. And in fact, it has driven so many decisions that we have made as a company and as individuals. I mean, I've written 3 real estate books. I've got 2 more in the works, and both of those are based on that principle. Both of the new ones are based largely on that principle of investing versus speculating, value investing versus going with the herd, boring investing versus exciting investing. They all started with that one insight. And I remember right where I was when I heard it. I knew about Warren Buffett, but somebody was explaining on a podcast, how they learned that from Buffett, who learned it from his mentor, Benjamin Graham. And that really changed almost everything for me.
Well, again, it's not to beat a dead horse, but being able to identify the difference between investing and speculating is so important. And when everybody's sitting around at the dinner table and talking about the stocks that they're buying and you should buy into it, that's absolutely not the time to buy in. And the same principle goes for real estate, right? I mean, when the demand is driving up the price, that doesn't mean that the value is actually what's matching that price. And so really understanding, is this a speculation right now? Or is there value in this investment that I'm making? And it's typically, going against the herd and not investing in, the things that everybody's talking about around dinner table or at the cocktail party.
That's really true, Courtney. And in fact, I just heard Jeremy Grantham, he's almost 90 years old. He's an investing legend from Wall Street. And he said he thinks that the stock market is literally about double where it should be right now based on objective criteria. And he's called every downturn, apparently, since the 80s perfectly. I mean, Again, I can't say perfectly, but you get the idea. He's done it really, really well. The thing I love about real estate, especially commercial real estate, is other than the 2008 financial crisis, which mingled Wall Street and real estate in an unholy way that was coupled together at that time, other than that, commercial real estate's value is not based on a CEO scandal, a war in the Middle East, or the mood on Wall Street. And I can pretty predictably, project what commercial real estate is going to be returning next year, no matter what happens to the potential bubble on Wall Street.
Well, and even comparing it to commercial versus residential real estate investing comprises, most times when you have an appraisal done, it really comprises of comps. A majority of the time, that is how the value is going to be determined. So you could do all the upgrades in the world, do a custom build, be on a premium lot. And if there's a house down the street that's the same square footage with the same, amount of bedrooms and bathrooms, your home is going to be valued off of that, not off of the, travertine countertops that you put in and, the gold toilets, as you said earlier. So again, it's really being able to be in control of identifying and doing good research and understanding cap rate, and being able to really secure some great lending at a low rate. And, you can have a highly profitable real estate portfolio.
Yeah, it's really true. And just like investing, like Berkshire Hathaway has opportunities through Warren Buffett that, most of us aren't going to get the opportunity to acquire. In the same way in commercial real estate, it's really, really hard to figure out. I mean, I have people on forums on Bigger Pockets where I'm at a lot. It's a real estate forum. They reach out and say, how do I, hey, I'm thinking about buying this $1 million self-storage facility. How do I run the numbers? Now think about that. $1 million, you're going to take $1 million risk, but you have no experience in it.
Yeah.
No offense to those people or anybody listening, but that's a big risk. How about start out with getting mentoring and training and coaching and reading books and maybe even going to work at a self-storage facility on weekends or whatever. Learn about it really well before you take a risk like that. Or just hitch your wagon to someone who's doing it really well. That's what my company does. We don't own and operate anything. We hitch our wagon to the best operators we can find.
Okay, so tell us a little bit more about your company and what you guys do exactly.
Yeah, my company's Wellings Capital, and we were a multifamily operator. And like I said at the beginning of the show, we started warning people that it was too overheated years ago. And so we decided we wanted to find other asset types that had more fragmentation, had more mom and pop owners, had more value left in them, sort of like Warren Buffett, the way he invests. He looks for value built into a stock, intrinsic value that's not realized in the price. Well, we found that in self-storage and mobile home parks. What we didn't find is we didn't have a team. We didn't have track record, history. We didn't have contacts. And we thought, oh, we'd love to invest in this, but we don't want to take our investors' money to invest in something we haven't done before. And so we asked our 120 or so investors, would you like us to go out and be a due diligence partner? And they said yes, for the most part. So we went out and we began to research the best self-storage and mobile home park deals we could find to invest in them alongside of our investor partners. And then we put that money together. We give them a diversified fund, and we invest across a lot of different operators, assets, geographies, and projects. And so our investors get a piece of all these very carefully vetted projects, but they can stay home, work on their retirement or their day job, and they don't have to do all the heavy lifting.
I mean, that's my kind of investing. I'd like to get some return without having to do all the heavy lifting. That sounds pretty nice to me. Where can the listeners find out more information about your company and you if they had additional questions?
Yeah, it's wellingscapital.com. That's WELLINGSCAPITAL, wellingscapital.com. And Courtney, I've got a resource that might be helpful. I, for years, was trying to figure out how to get into commercial investing, but I didn't know how. And I've created a 5-day course that's free. People can go through. It's wellingscapital.com/resources.
Oh.
And that will give them access.
Okay, I'm rewinding. That was my rewind sound. A 5-day free course to help people understand how to get into commercial real estate. Did I hear that right?
Yeah, that's right.
My mic didn't give out. Okay. I just want to make sure that the listeners understand who gives away a free course, guys. That's golden opportunity. So wellingscapital.com/resources.
That's it.
Okay. I'm going to make sure to link it in the show notes. Guys, pause the episode. Make sure that you go pull that up. Actually, you don't even need to pause it. It'll just keep playing on your phone while you click on the link in the show notes. Go check out that resource, a 5-day free course, wellingscapital.com. I'll make sure to link everything in the show notes so that way you can easily access this if you're driving or whatever the situation is. But Paul, thank you so much for coming on today. I really appreciate it. And thank you so much for talking about the course and your website. I'm excited to have everybody check that out.
Well, thanks, Courtney. It's been a real honor to be here. I really appreciate it. And hope to, maybe we can connect again over and drill down on some of these things like self-storage, mobile home parks, or tax savings, whatever you think that people would be interested in.
Okay, we're gonna schedule a follow-up episode, and we're gonna talk about self-storage because I have a lot of people that reach out and ask if that's a good investment. I said, I've never invested in self-storage, so I can't speak to that. So we're going to do a follow-up because I know that the listeners would want to hear more about that. So thank you so much. And guys, if you're not already following me on TikTok and Instagram, it's at Financially Free Journey. And I post daily tips and motivation to help you on your journey to financial freedom. Thank you so much for tuning in today, guys. And I look forward to talking to you again next week. Until next time.